Welcome to Black Letter Money. The moment you drove off that lot, your car lost between 9 and 11% of its value. By the end of the first year, it had lost up to 20%. But your loan balance, that barely moved. Most people think the car business is about selling cars. It's not. The finance office, that room you sat in after you already fell in love with that brand new vehicle, is where the dealership makes some of the biggest margins. And almost everything that happens in that room is legal, disclosed nowhere, and designed to extract as much money from you as possible. Today, we're going to walk through exactly how it works. In this video, we're going to cover 4 things. First, the rate markup you never knew existed. Second, the products they sell to you in that finance office and what they actually cost. Third, yo-yo financing, a practice that is widespread, fairly regulated, and genuinely predatory. And fourth, the loan structure itself and how the math of the modern car loan is designed to keep you perpetually paying. This is not legal or financial advice. These are documented practices, verified against CFPB guidance, FTC records, and industry data. This is black letter law and the absence of it. When you finance a car through a dealership, here's what actually happens. The dealer submits your information to a network of lenders. Those lenders respond with what's called a buy rate, the actual interest rate they are willing to offer you based on your credit score and financial profile. That rate is sent to the dealer, not you. The dealer is then allowed by the lender to mark up that rate before presenting it to you. The difference between the buy rate and the rate that you are given is called the dealer reserve. The dealer keeps that as profit. You never see a buy rate. You never know the markup exists unless you specifically ask or have a competing offer from another lender. The typical markup is between 1 and 2.5%. That may sound small, but it isn't. On a $30,000 loan over 60 months, a 2% markup costs you approximately $1,600. That money goes directly to the dealership for doing nothing more than changing a number on a document. The CFPB confirmed this practice explicitly, and it has noted that it creates a significant risk of discriminatory pricing because dealers have the discretion over who gets marked up more than others. Senator Edward Markey sent a letter to the FTC in 2013 documenting that the auto industry's own data showed the average markup was at least 2.5 percentage points, and that customers who financed through the dealership were paying over $25 billion in rate markups annually. That was 2013. The practice is still legal, still widespread, and still undisclosed. After you've agreed on the car and the rate, you're taken to the finance office. This is where the real work begins. The finance manager will present you with a series of add-on products, extended warranties, paint protection, tire and wheel coverage, credit life insurance, and the one we need to talk about specifically, gap insurance. Gap, guaranteed asset protection. This covers the difference between what your regular insurance will pay if your car is totaled and what you still owe on the loan. Given how quickly cars depreciate and how slowly loan balances decline, gap can genuinely be useful. The problem isn't the product, it's the price. Through your own insurance company, gap coverage typically costs between $20 and $100 per year. You can add it to your existing policy, cancel it when you no longer need it, and pay nothing beyond the annual premium. Through the dealership, gap is sold at a flat fee, typically between $500 and $700. And that fee is rolled into your loan, which means you pay interest on your gap insurance. The National Consumer Law Center found that some dealerships mark up gap insurance by 300%. Some cases documented markups of over 1,000% compared to what the same coverage costs through an insurance company. The CFPB is explicit on this. GAP is optional. If a dealer tells you that you must purchase GAP to qualify for financing, ask them to show you where in the sales contract it says that. In most cases, it doesn't. If you already purchased a dealer GAP and you refinance, sell, or pay off the loan early, you may be entitled to a refund of the unearned portion. Most people never ask. Let's say you negotiated the price. You agreed to the monthly payment. You signed the paperwork. You drove the car home. The car is in your driveway. Your trade-in is gone. The deal is done. Then the dealer calls. The financing fell through, they say. The lender came back with different terms. You need to come in and sign new paperwork or return the vehicle. This is yo-yo financing. It is not illegal under federal law. Here is how it works. When you sign a purchase contract at a dealership, the contract is often conditional. Conditional on the dealer finding a lender willing to buy the loan. Most buyers don't know this. The contract looks final. The dealer hands you the keys, but the deal isn't actually closed until the loan is sold to a lender. If the dealer decides the offers they are receiving aren't profitable enough, they can call you back in, claim the financing fell through, and pressure you to sign a new contract with a higher rate or larger down payment. Your trade-in is already gone. You've already told your family you bought the car. The pressure to sign is enormous. One survey of 40 consumer attorneys documented 900 yo-yo financing cases in a single year. No federal law stops it. Some states have passed their own protections. California requires dealers to notify buyers within 10 days and return all money if financing falls through. Washington State classifies it as a violation of the Consumer Protection Act. Most states have done nothing. The single most dangerous question a dealer can ask you is, what monthly payment are you looking for? The moment you answer that question, you've handed control of the entire transaction to the finance office. Because when the focus is on your monthly payment rather than the total cost, the dealer can extend your loan term, roll in add-on products, and bury fees while keeping the monthly number exactly where you wanted it. You walk out thinking you got a deal when you really didn't. The average car loan term in the United States is now 68 months. Nearly 23% of new car loans are now written for 84 months, 7 years. That is a record high as of early 2026, and the consequences are predictable and severe. In a 7-year loan, you spend the first several years barely touching the principal. The vast majority of each early payment goes to interest. Meanwhile, the car is depreciating rapidly. This creates negative equity, a situation where you owe more than the car is worth. As of Q1 in 2026, nearly 31% of trade-ins towards a new car purchase had negative equity. This is the highest share on record. The average amount owed on those underwater trade-ins was $7,214, an all-time high. When those buyers trade in, the negative equity gets rolled into their new loan. The cycle continues. Borrowers with 84-month loans carry a median negative equity of $8,485. Compare that to borrowers with 36-month loans who have a positive equity of $7,783. The length of your loan is not a neutral financial decision. It is the difference between building equity and perpetually starting over. Here is what it means in practice and what you can do about it. First, get pre-approved before you walk into a dealership. Go to your bank or credit union. Get a pre-approval letter and know your rate before you sit across from a financial manager at a dealership. That one step removes the dealer's ability to mark up your rate. You walk in knowing the number. You compare it to what they offer. If they can beat it, great. If they can't, use your own financing. Second, never answer the monthly payment question. The question you should be focused on is the total cost of the loan, the out-of-door price, the interest rate, and the total amount of what you will pay over the life of the contract. Monthly payments are how the industry hides the real cost of what you are buying. Third, every add-on product in the finance office is optional and negotiable. Gap insurance, extended warranties, paint protection, all of it. If you want Gap, buy it through your insurance company for a fraction of the price. If you've already bought dealer Gap and you pay off the loan early or refinance, ask about a refund. Fourth, if a dealer calls you after you've driven the car home to tell you the financing fell through, do not panic and do not sign anything immediately. Contact a consumer attorney. In some states, you have significant protection. In others, you need to document everything in writing before you return to the dealership. The car financing system was not designed for you. It was designed around you. Knowing how it works is how you navigate it. If this is the kind of thing you wish someone had explained to you sooner, there's a lot more where this came from. Subscribe to Black Letter Money. This is what we do here, the law and the money. Together, explain clearly. I'll see you on the next one.